Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey, welcome back, everybody, to another episode of DIY Wealth Canada podcast. I'm Bob. Below me is my co-host, Nelson. Today, we got a really fun episode, and I'm not kidding. Due to popular demand, we're going to talk about our top 5 holdings in our investment portfolio. This should be an interesting one, Nelson, I think, because we haven't really talked about our top 5 holdings, even on our blogs. I think I certainly haven't listed them out myself on my blog. I think you list them out maybe on your pay section. So yeah, it should be a fun one to talk about our top 5 holdings.
It seems like what everybody wants to hear is exactly what you're invested in, and rightfully so. You know, like it's the whole put your money where your mouth is. And obviously people are curious. I'm always curious when I talk to people, you know, like, hey, what do you own? What do you what's that you can like a stock all you want, but to actually put money in it, that's a big deal. So I think that's why it's such a popular topic. That's why people always want to know. And this should be a good episode. We're going to talk about it. There might be a little bit of surprises, but that's what keeps things interesting. I'm excited.
For sure. So let's get right into it. So we go. Do you want to go number 1 to number 5, or do you want to just list them out like not in order? Like, what do you want to do?
Why don't we alternate, where maybe we'll talk about, like, we'll do number 5, so say you'll go first, you'll talk about your number 5, and then I'll talk about my number 5, and then we'll kind of alternate throughout, maybe ask talk a little bit about them, ask some follow-up questions, and we'll do it that way.
That sounds perfect.
Okay, so you start. What's your number 5 position?
So I'm just got my portfolio spreadsheet open right now. So for listeners that don't know, I developed a spreadsheet template that's available on my blog. So basically, we look at all of our portfolio, meaning both dividend holdings and index ETFs, and we aggregate everything. So it's easy to see what we have in terms of number 1 down to bottom of our portfolio. So number 5, funny enough, it's actually a kind of a 3-way tie at the moment. So it's actually Apple, National Bank, and CIBC. They're within like a few dollars of each, like less than $5. So they're currently all tied for number 5 spot. So Apple, we've been investing in Apple for a very long time. I wish I had invested in Apple earlier when iPhone was first announced, but we got in a little bit later. And so Apple has done tremendously well for us. I think looking at the spreadsheet, it's definitely it's a multi-bagger for us. So Apple has done really well. Has kind of been flat a little bit this past year, I would say. At the time of recording, it's a little bit off the 52-week high, and it's kind of bounced around there a little bit the last couple of years. Like both National Bank and CIBC have done really, really well. CIBC actually was a lot lower in our portfolio in terms of ranking, but it's been 36%, over 36% the past year. Year to date is actually over 25%. So that kind of shot up the last year. Whereas, National Bank, looking at the chart here, it's just a little bit over 14% year to date, and over the past year is 16%. So yeah, CIBC has done really, really well the past year. So that's why it's now one of the top 5 stocks that we own in our portfolio. Nelson, what about you? What's your number 5?
My number 5 is Capital Power. And so for those of you who aren't familiar, because it's not really a household name at this point, it's quite popular in the kind of dividend space in Canada, but not really a household name. So Capital Power is a independent power producer, IPP, that has operations mostly in Alberta, but is also diversified into Ontario and into the United States. They recently bought assets in California, Arizona, and then one in the northeast of the US. So they own primarily natural gas fired power plants. And there are a few reasons why I liked this one when I was buying it. This is one that I've held since 2019, and then I've averaged up on it 2 or 3 different times. I bought most of my position in kind of the mid 30s, and it's, as we're talking right now, it's a little bit over $70 a share. So it's done quite well for me on the capital gain side, which is why it's grown to be a top 5 position. So my thought process for buying it was sort of twofold. One is it was very cheap on a price to AFFO metric, and AFFO is not technically earnings, but I feel like it's pretty close to earnings because power plants have large depreciation costs that eat into the bottom line, especially if you finance them and buy them. So there's that. The other thing is that I think that natural gas as a fuel is a great choice for this kind of bridging the gap between, coal and renewables in terms of power generation. We're not quite there to the point where we need renewables or we can count on renewables to power the entire grid. We need natural gas, especially when there's inclement weather. Canada, it snows, it's cold, etc. So those two kind of things put together. I'm also a fan of the data center thesis. Of course, big tech companies are building a lot of money to build data centers, and those data centers need power. And that is a additional part of the thesis there as well. I think that the natural gas power producers benefit from that. So that's kind of my thought process with Capital Power. Bob, before we go on to your number 4, I want to ask you more about Apple, because Apple is potentially a bit of a controversial stock in terms of the criticism is that Apple isn't really innovating and it's just sort of cruising on its previous laurels. It just hasn't, the new phones are only slightly better than the old phones, and ultimately that sort of there's potential for a upstart newcomer to show up and start taking market share there. Is that something you worry about as a Apple shareholder, or have you just the moat is so strong that you don't think that's ever going to happen?
Oh, absolutely. I think that's the concern with any tech stock, right? Because things move so fast in high tech. Now, Apple, it's almost becoming a consumer staple stock in that sense that they're coming out with these products so regularly. You can kind of count on what they're going to announce, right? Like just yesterday, I think they announced their latest M5 silicon with like iPad Pro and then MacBook Pro and then the Vision Pro 2. So it's almost like clockwork that what they're going to announce. There's really no, the famous Steve Jobs, like, oh, one more thing, and he pulls out a MacBook Air and fits into the envelope, right? That has gone away. So yeah, the innovation is a concern, but if you think about it, they've still been innovating, maybe not in the traditional sense, right? They came out with the Apple Silicon, which was a game changer, right? When they announced the M1 Silicon, like the amount of power it was, well, not power, but processing power these silicons had was so much better than anything available at the time. And they've been incrementally improving things. And, Vision Pro, I would say it's kind of a flop. I've seen people using it in real life and it just looks goofy. But if you look back, like Apple Watch, when it first came out, it was kind of a flop. But nowadays you kind of see a lot of people in Apple Watch as you walk around town. So I think with Apple, sometimes their products flop, but they kind of incrementally improve to a point where eventually there's higher adoption rate. In terms of innovation, I think it's still there. They're definitely catching up on the AI side, but I think knowing their history, I think they will catch up. Now, the one thing I noticed yesterday with their announcement of Vision Pro 2 is if you look at the smart glasses, VR, XR space, like with Meta, with Apple and whoever else that have XR, VR glasses or goggles. I would say Apple is the only one that really controls their destiny. What do I mean by that? Like if you look at Vision Pro 2 and Vision Pro 1, Apple used their own silicon, right? The Vision Pro 1 used, I believe, M2 Pro? No, M2. And then the Vision Pro 2 uses M5. So they're controlling all their hardware, their development, etc. Whereas if you look at Meta, they're relying on another company, in this case, like Qualcomm, to come out with new chips so they could use. So they're kind of tied by somebody else. So Apple, if you look at their recent trend, they're instead of using chips and hardware from other vendors, they're developing their own chips. So they're innovating that way rather than coming out with a new different product in a different product segment. So is the innovation going away? I guess so in the traditional sense. So it's definitely something to monitor, especially with how AI plays out. So that one, we're keeping a close eye on it, but with the strong ecosystem, we're not too overly concerned for now. So that's an interesting question, Nelson.
Yeah, I look at it in a much simpler perspective because, like there's a lot of, your tech knowledge is definitely higher than my tech knowledge. Mine is pretty much non-existent. And, you touched on the consumer products part of it. And I look at things like the watch and things like the AirPods and, things like that. And it's just like, these aren't really, like the technology to make these things is not the hard part. The hard part is, marketing them and getting them to the masses. And with Apple, you have to have a lot of people to buy something to kind of move the bottom line. So, but the ecosystem, the Apple community of users, and I mean, I have a iPhone as well, and that's the big strength with Apple. And then if you can just release incremental devices, whatever, I think that's enough to move the stock higher over time. And in the meantime, you get that, that massive share buyback that they're doing to also help the bottom line. Okay, Bob, what's your number 4 stock? We talked about your 3-way tie for number 5. What's your number 4?
Yeah, number 4 is another Canadian bank. So number 4 is Royal Bank. It used to be a little bit higher, but Royal Bank hasn't, I guess, done as well compared to CIBC and such. So Royal Bank, again, I think we talked about Canadian banks in other episodes. We generally speaking like the Canadian banks. Canadians don't regularly switch banks, and Royal Bank, just like the other big fives, that has been paying dividends since the late 1800s, uninterrupted. Yeah, you see Royal Bank basically everywhere you go in Canada. So they're pretty solid. So that's our number 4. Now, so do you own any? Oh, I guess we'll hear about your other holdings in your top 5, but I'm very curious if you have any Canadian banks in your top 5.
We will talk more about Royal Bank later, is the little tease that I'll give everyone. So don't worry. Number 4 for me is Imperial Oil. And this may be a little bit of a, so for those of you who don't really follow me on X or Twitter or whatever the kids call it now, I'm generally a little bit negative on oil because, one, you can't predict the price of oil. Nobody can. If someone tells you they can, they're lying. Because let me tell you, if I could predict the price of oil, I sure wouldn't be telling anyone on social media about it. I would just quietly be taking my profits and, smuggling them to my deserted island somewhere. So why do I like Imperial Oil? And there's a few different reasons. One is these guys have long life oil sands assets. So these guys have enough inventory in the ground to produce for another 40 or 50 years. And that doesn't even include any kind of nearby oil that they can discover that are very near their reserves right now. So I like that. I don't like that traditional oil companies have to keep finding new oil. I don't like that they have to explore and spend money on building new, I guess not building new drills, but getting the equipment in and using it to buy or get new reserves. So I don't like that. The other thing I like about Imperial Oil is they've got these downstream assets. They own large refineries in Alberta and Ontario. And these are just, they deliver steady profits that do fluctuate some depending on the spreads, but these are generally kind of the more steadier profits of the oil business. And finally, what I really like about Imperial Oil is they have this pristine balance sheet. There's basically no debt, which really, really helps in terms of paying dividends, in terms of repurchasing shares, and et cetera. And speaking of repurchasing shares, Imperial just goes to town repurchasing its shares. I think it's repurchased something like 35 to 40% of its stock in the last 10 years. These guys just take their earnings and they just hammer the share buyback, which then increases earnings per share without the help of oil. Obviously, oil is the price of oil is the driver here, but these guys have built a system where earnings should go up over time, even with oil fluctuating like that. So I just put all that together. Plus, it's got a 30-year dividend growth streak. History should increase the dividend again in December. And it's just like the best. I think it's the best oil company on the planet. I think it's the best run oil company on the planet. And even though I don't really love oil, it's just, this is a stock that has done incredibly well for me. I think I'm up about like 400% on it, including the dividends over time. It's just been a wonderful investment. And it's something that is just, it went from like a medium-sized position in my portfolio to a top 5 position, just simply because of how much it's grown and how well it's done. It's just been spectacular, and I hate it a little bit because it's oil and I don't love oil, but the company's well run enough that I'm willing to look past that.
Nice. And Imperial Oil, we don't own. Like we've been kind of slowly getting out of oil producers. I think the last one we owned was Suncor. Well, I guess Canadian Natural Resources, in that sector, so that counts. But I forgot to mention, you mentioned about Capital Power. That's something we own in our portfolio as well. And that one has been slowly moving up the ladder in terms of ranking, because it's done so well the last year. So that's nice to see. But obviously not quite enough to make to our top 5 yet. So number 3 for me right now, if I look at it, is it's not a dividend stock. So it's XAW. That's the iShares X Canada World Index ETF. So that one is an index that tracks the rest of the world outside of Canada. So basically, that's our play for international exposure and diversification via different countries, geographic, and different assets. Now, we learn over time that dividend stocks are great, but you can't own them. You can't own them all. So that's our way of diversifying by owning XAW. And that's been doing pretty well. Like, I think not long ago, it was under $40. Now it's at 51. So that's kind of our way to call it hedging or whatever, way to play outside of Canada. Right? So I think that index has done well, and we've been just slowly adding more shares over time into XAW and just dump money in there and leave it at home. So that's number 3.
Before we move on to my number 3, let me ask you, Bob, the XAW, the criticism that I've heard about it, I'm not I don't know this one in detail, so you'll have to help me out a little bit here, is the criticism of XAW is that the US market is so dominant that XAW is essentially a play on the US market. And if you want to get that, why not just, go to a S&P 500 or something like that, kind of that product? What would your response to that be? Like, what was your thought process in picking that one over, say, because I think we're going to talk about some other ETFs you own in a minute here, not to spoil anything, but so why that one versus say, like some of the more pure play US alternatives?
Yeah, I mean, the way we thought about it is US doesn't own the entire world. There are innovation outside the US. Sure, XAW owns quite a bit. And just looking up on the website at the time of recording, it's just a little bit under 65% of XFW is in the United States. Right? So the next biggest one is Japan at just like 5.51%. So yeah, I mean, we could definitely own S&P 500 and just leave it at that. But we also own another index. It's called QQQM, which is the Invesco NASDAQ 100 index. So basically it tracks the top 100 stocks in NASDAQ. And the way we know NASDAQ well, it's mostly technology companies. So we get already quite a bit of exposure with technology companies. And some of these technology companies make up the S&P 500 anyways. So that sense, we don't want to overexpose ourselves in the US market. We do want to tap into other countries. Right? And really, if you look at this year, 2025, Canada has been doing better than S&P 500, like TSX. So just because S&P has historically performed better, it doesn't necessarily mean they'll continue to perform well. So that's kind of our rationale. Just we want to be diversified. Like, you never know what's going to happen in the future. So, yeah, I mean, we could easily just put money in S&P 500 and money in NASDAQ 100 and do that. But we just like XCW because that gives us a little bit more exposure outside of Canada and US.
Yeah, and that's a perfectly reasonable explanation. And at the end of the day, the US market in terms of the technology it's so prevalent in the rest of the world. I just got back from South Korea, and South Korea is the hotbed of Samsung, LG, these like kind of alternative tech companies, the tech scene outside of North America. And even there's tons of iPhones, there's tons of Apple Watches, and so on. So it just goes to show how much that US presence is around the world, but also how US tech companies aren't just US tech companies. They're worldwide tech companies that just happen to be exposed or headquartered in the US. My number 3, and this is where I was kind of teasing everyone about how the Canadian bank's going to make an appearance again, because my number 3 is TD Bank. And I think we've almost talked about all the Canadian banks here, but in terms of TD, I bought a bunch more of that one back in 2024 with the money laundering scandal in the US. A very quick story there for people who aren't aware is that TD was accused of taking some deposits that were linked to the drug trade. And the regulators were obviously very upset about that because they broke some rules when they did that. So TD got this massive punishment, billions and billions of dollars worth of fines, and the stock tanked on the news. I looked at it and I thought, this is a good long-term company that has just made a mistake, and it was a very costly mistake, but there was potential to turn things around. The CEO was leaving, they were going to put a new CEO in charge, and the Canadian assets were unaffected. And, TD's Canadian assets are something like, 65-70% of the company versus kind of 30% in the US. So the majority of the company wasn't going to be affected by this. And even in the US, I don't think it was going to be that big of a deal. I didn't think that people were going to close their accounts or anything like that. There's some challenges that TD would have to face in the US, but I thought they could maneuver through them quite effectively. So this is one that I had held since, this is the very first stock that I bought in 2002 was TD Bank. And then I sold it like in 2004 or something, but I had held it again since maybe like 2017, 2018, somewhere in there. And it was disappointing, but I averaged down on it in a relatively big way. And now it has performed extremely well. It's close to a new all-time high. That last set in 2021. The new CEO has really gained the confidence of the market, I think, and its Canadian operations just keep chugging along. I think it's neck and neck with Royal Bank in terms of the best managed bank in Canada, and that's something that I want to hold over the long term. Just a wonderful company that I was happy to add when it was cheap, and now that it's a little bit more expensive, I just want to hold it, kind of just relax.
Nice. Yeah, that's TD. I'll talk about TD later on, but we did a similar thing as you, Nelson. We're just looking at our historical transaction. We bought a lot of TD back in 2020 when it was close to $60, right? So it was done well, and then during that money laundering scandal and the aftermath of it, we also saw that as a buying opportunity. So we bought a ton of TD during that time as well. I mean, we had a lot of TDs back then before that, but we bought more because we thought TD is a good long-term hold, and at that price, I think back then during when the money laundering thing came out, I think it went down to like below $80. I think it reached to like 75 at some point. So we were buying.
Yeah, 75 is when I added to buy.
Yeah, so we bought like all the way down to 75, like during when it was going down. So and then even earlier this year, I think, like the CEO hasn't changed. So like the TFSA, I think it was my wife's TFSA, we bought over 7,000 or close to, only TFSA contribution for TD. And I think we bought it at like $76-ish. And that has done well, right? Just that single move has returned over 45% this year. So that's done really well. And kind of the same idea as you, Nelson. We felt that was just a short-term pain for TD. And you look at TD's exposure in Canada, they're just making tons of money left, right, and center. Sure, US, they might get penalized a little bit, but they have a stronghold in Canada. So we didn't think that's an issue. Now, did we think it would recover that quickly? No, didn't think it would recover that quickly. So, and that, I think that's something everybody needs to understand. When you look at building wealth and investing, you need to look at from a long-term point of view. Like if you look at these analysts on Bloomberg or these radio shows or TV shows, quite often they're talking about their top picks in a very short term, right? They're talking about like in the next 6 months or even shorter, and they're picking these stocks based on their view of the short-term performance of these companies. But if you're holding a stock like 10, 15, 20, 30 years plus, when an opportunity like TD we saw in 2024 or even earlier this year, if you're holding for that long term, how many years, it's worth it to invest and take the opportunity. So that's my view on TD. And I think we were thinking exactly the same way back then, Nelson. So back on track. So number 2, surprise, not a Canadian bank, but number 2 for our holding right now is Enbridge. It actually retrieved a little bit, used to be number 1. I think Enbridge was doing really well a few months ago. It actually reached 52-week high, but it has retrieved a little bit, so that dropped a little bit. We like Enbridge because it's a pipeline company. I think we talked about pipelines in a previous episode, where it's getting increasingly harder and harder to build new pipeline networks. So what happens to the existing pipeline networks? They're even more valuable than before. And Enbridge has a vast pipeline network and transporting crude and natural gas. And that's something we're not going away from, crude and natural gas, even though we're trying to move away from these so-called dirty energy resources. So yeah, I think we will continue to rely on Enbridge. And it's nice that Enbridge has a pretty good dividend yield and has a history of raising dividends over the I don't know what their streak is now, but they have raised dividend payout consistently. So that's something we have done quite well with Enbridge. So yeah, that's our number 2 stock in our portfolio.
I am also a fan of Enbridge. I have it in my portfolio. It's not in the top 5. I'm actually looking, it's not even in the top 10, but it's close. So it's a relatively large position for me as well. And what I like about Enbridge, Bob, you talked about the pipeline aspect of it, and you're right, like that stuff is not going away. And if I'm a bull on natural gas power, which I talked about with Capital Power, then you need that natural gas to get transported to the power plant somehow. Like you can't just, put it on someone's back or put it in someone's car. Like, you need a pipeline. And actually Enbridge and TC Energy, the 2 kind of main natural gas pipeline companies in Canada, they've identified that as an opportunity, both in Canada and the US, where they've said, hey, we have these, coal power plants in the US that are slowly moving to natural gas, which is which is the right thing to do. And these plants need the natural gas transported to them somehow. And these guys, both these companies have such large networks that they've identified sort of this opportunity where it's like, hey, we have a pipeline 20 kilometers away, whatever. It's not a big deal to build something and kind of connect it to this power plant. And it's a good little incremental investment for them. So that's another reason why I'm a fan of both Enbridge and TC. Okay, so number 2 for me it's CIBC. And so we talked about CIBC a little bit with you, Bob, so I'm not going to get too much into the bank itself. All I'll just say in terms of the performance and in my portfolio, this is one that I was buying in kind of 2021, 2022. It was very, very low. I think with my average cost is probably in about the $55 range. And of course, it's much higher than that now. So that's just been another one where I did very well on the capital gain side while locking in a very attractive dividend. But rather than talk about CIBC more, I want to just talk about Canadian banks a little bit more in general, because I think a lot of the people listening in terms of dividend investors, they're going to have a lot in Canadian banks. It's just they've done so well. They've been so steady. They've made so many Canadians rich over these long, long periods of time that I think they're going to be very popular with our listeners. So, Bob, is there ever a point when you would consider selling a Canadian bank? Could they do anything to kind of mess up the thesis for you and have you say, hey, you know what, I made a mistake? Or maybe that, hey, this is too overvalued, I don't want to hold it anymore?
Yeah, that's a good question, Nelson. We did thought about trimming a little bit of TD and Enbridge just because both were doing quite well this year. But the more I thought about it, like, why trim winners when they're just keep going up? Like, and it doesn't make any sense. So we decided to hold off on trimming any TD or Enbridge, and same thing with CIBC. Like, I'm just looking at our historical purchases, and I think I have written about some of these numbers on my blog. Like, we got quite a bit of CIBC in 2020, and I think we had an average price of like low 30s. I could mess up the calculation because they had a share split. So, but yeah, we done well with CIBC. But to answer your question, the only one we have sold trim a little bit was Bank of Nova Scotia in recent years, just simply because they have not done too well with their Latin America strategy, but they're pivoting a little bit, and that has improved the performance of Bank of Nova Scotia. And, the big six, I have no concern with how any of them perform. Now, years ago, we did purchase some shares of Laurentian Bank, LB, and that was, looking back, that was like, we were really focused on dividend growing streak and dividend payout growth. And we thought, hey, the other banks have done so well for us, why not tap into a smaller bank? But LB was just too overly exposed to Quebec, generally speaking, and that one kind of burned us in the back. So that was an exception where we got out of the Canadian bank position. But the big six, like the Royal Bank, TD, Bank of Nova Scotia, BMO, CIBC, National Bank, I had no concerns with them. And if their share price drop, I have no concern to buy more. But right now, I think all of them are kind of close to the 52-week high or even all-time high. So we're just kind of letting them ride and see what happens. What about you, Nelson? Would you ever think of exiting the Canadian bank?
I think that you summarized it really well in terms of just talking about how well the big six are managed versus, say, something like Laurentian, which I think every Canadian dividend investor has made a mistake owning Laurentian at one point. I had a little bit back years ago, and this is before they cut the dividend, but it just didn't perform. The underlying metrics in terms of like return on equity, in terms of earnings growth, things like that, they just weren't there with that one. But the stock was and still is quite cheap compared to its peers, and that lured me in, and that was a mistake on my part. Fortunately, it was a small position that I didn't lose too much money on, and I moved on. But one thing I will mention about selling Canadian banks, and I'm with you, I don't have any plans to do so unless one really starts to struggle operationally. But even then, I'm likely not to sell. The other thing that I want to mention is that for me, anyway, I have so many Canadian banks in my taxable account, and selling would generate a tax event. I would have to pay capital gains taxes because my Canadian bank shares have done quite well. And that's something that I do not want to do because it interrupts the compounding process. You take you've created a situation where you have to pay, whatever it works out to be in taxes, it's like 25% of the proceeds. And then when you reinvest, you're reinvesting less capital into the next stock, whichever one you pick. So that for me is a major negative when it comes to selling anything. And I think something that folks should consider in a world where people are increasingly short-term oriented. It's a little bit discouraging, actually, but that's another topic for another day, because we have to talk about, drum roll, your number one position, Bob.
Yeah, I think listeners probably have figured out already. Our number one is TD. Just again, looking at the chart, it has done tremendously well after the CEO change, right? So I think year to date is up over 43%. 1 year is over 44%. So yeah, that TD stock has shot up in our portfolio over the last year. It used to be a lot lower. It was still in the top 10. I think it was always been on the top 5, but it just shot up. So it actually overtook Enbridge in recent days. And we already talked about Canadian Bank. So yeah, that I have no problem having TD as our number one stock in our investment portfolio. And I think TD will continue to do quite well over the years. I think I may have seen your tweet, Nelson, about TD's investor presentation where I think the CEO or CFO was saying they plan to compound. I can't remember the exact number, like 15 or 16% annually or something, or some really high number, which I'm like, that sounds great to me. So no plan exiting TD anytime soon.
Yeah, I did actually. I didn't watch the presentation, but I did read the slides and everything. And it's a really concise plan that should, like, it focuses more on the Canadian assets, which I think are the best part of TD, while also maintaining that U.S. exposure. So for me, my number one stock, and again, we're going back to Canadian banks because we both love our Canadian banks. Mine is Royal Bank. And I'm actually looking at the numbers here, and it's actually my largest position by a little bit here. Like it's the gap from 2 to 5 is quite small. And then Royal Bank has kind of leaped beyond that in terms of my top position. So it's my top position by a considerable amount. But I mean, just to give everyone some perspective, I'm quite diversified. I have something like 80 different positions that's slowly getting whittled down over time because I realize I have too many. So keep that in mind when I talk about my top position. I don't have this it's not a 20% position in my portfolio or anything. It's more like a 4% position. So before anyone gets too excited and accuses me of concentrating, in terms of Royal Bank, I think it's the best bank in Canada, and that takes nothing away from like a TD or a National Bank, which are both excellent competitors. I'm sure a constant pain on their side, but ultimately Royal Bank is the best. It is the best managed, I believe. It's got the number 1 or number 2 market share in most every Canadian banking category, which I think is huge. And then it's got the US assets, which I think are about 25% of earnings, which I think are a little bit more solid versus, say, TD's or BMO's US assets. They're a little bit more kind of focused on higher net worth, higher wealth people, which I think is the better choice into the US. I think the more kind of niche approach rather than, getting into everyday banking for everyday people is the right thought process. But ultimately, I'm so impressed with the way that Royal Bank manages themselves. They make smart acquisitions, and they're just, when you think about quality in Canadian banks, you can argue kind of who's good, who's not good, but I never see anyone argue that Royal Bank is a bad Canadian bank, and that was a big reason for me why I held this one. This is one that I think I first bought in 2018. And then in 2020, during the COVID chaos, I was very aggressive in adding to this one. It was kind of the rare time that the stock was cheap. And I was just happy to add more to my portfolio. And then more in 2023 as well, when kind of that fall of 2023, when it seems like every dividend stock in Canada was on sale because everyone was worried about interest rates. So that's one I would say with Royal Bank. In terms of, would I buy it today? No, it's too expensive, but I'm happy to hold. And, this is one that I think that when it trades lower, and it inevitably will, that's a good time to pick up shares rather than chasing it at an all-time high.
Yeah, absolutely. I think I think all the Canadian banks are, like I mentioned, pretty high right now. Would I add more? Probably not today, but whenever there's an opportunity, it's definitely worth to get just kind of dollar cost average and then kind of nibble on a few more bank stocks. I think that long-term strategy has done really well. And kind of like that's how we got quite a bit of TD if it was down before. We should have bought more Royal Bank. We also like Royal Bank a lot. But sometimes it's harder to get buying opportunities when these companies are well run. So you kind of have to find your opportunity points.
Yeah, and very quickly, I think we're almost out of time, so I'll just very quickly talk about my Canadian bank buying strategy, which those of you who follow me on Twitter, I've said this many times there before. Maybe it's time for another tweet to kind of remind everybody, but my strategy for buying Canadian banks is quite simple. It is I wait until they're trading at or near 52-week lows, and then I buy the one that is trading there. That's it. It's if a Canadian bank stock's at a 52-week low, I'm usually there buying. And if there are multiple Canadian bank stocks at a 52-week low because the entire sector has sold off, then at that point, I'm buying more of the higher quality ones versus the lower quality ones. And I say higher quality versus lower quality in Canadian banks. I think they're all good. It's just, I think Royal Bank, TD Bank, and National Bank are a little bit better than BMO, Scotiabank, and CIBC. So I would be more inclined to buy the ones that I think have the higher quality versus lower quality. But at the same time, if BMO was trading at a 52-week low and nobody else was, I would be there buying shares at that point, because a Canadian bank at a 52-week low, in terms of the big six, we can talk about Laurentian and maybe like EQ Bank and VersaBank and some of the other ones that I don't think are as high of quality. Not that I don't own, like I do own EQ Bank, but ultimately for me, it's if the entire sector is at that 52-week low, those are the three I'm looking to buy rather than the other ones. But anyway, so I think that we're about out of time here. Bob, is there anything you wanted to add before we go?
Yeah, I just want to talk about that Canadian bank buying strategy. I absolutely agree with you. Another way to look at it is you can look at their historical dividend yield, and if the yield is a lot higher than your historical average, that's typically means the stock price is lower, and it's probably a good time to take that opportunity and buy some. So that's similar to your 52 low strategy as well. But look at the historical data, and that gives you an idea. So.
I love that. And I don't think people should limit that strategy to just Canadian banks. I think you can do that with just about any dividend paying stock in North America, where and that's not the only piece of research you should do. You shouldn't just go blindly buy a stock that, offers a 4% yield when a 2% yield is sort of more normal, but it's a very good screening mechanism for finding cheap stocks. And then from that point, then you would look at it and kind of make your decision there. But yeah, I love that dividend yield as a proxy of value strategy. I think there's a lot of wisdom in it. And I think it's dismissed by a lot of people because it's so simple. It just seems like it shouldn't work because it's like, how hard is that, Bob, to look at a stock's dividend yield and say, oh yeah, look, it's undervalued based on the yield. Like, it sounds stupid, but there's actually a lot of wisdom in it.
Mm-hmm. Yeah, it boils down to these simple strategies, right? Especially when it comes to dividend investing, you don't have to make it too complicated. Just look at the historical average and 52-week low. If it's a good company, again, think long term, right? Like buy 10, 15, 20, 30 years plus. When there's a buying opportunity, back up your truck. That's what we have done in the past, and we get rewarded for doing that.
Exactly. Well said. So anyway, thanks everyone for joining us. Always a pleasure to get together with Bob and talk stocks and our strategies and everything. If you want to hear more about Bob, you like what he said, you want to read his stuff, he can be found at Tawcan. That's TAWCAN.com, and on Twitter as well. That's his username. There's Tawcan as well. And I can be found at CanadianDividendInvesting.com. And my Twitter name is at CDI Newsletter. So everyone, thanks for listening, and we'll see you next time.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at Tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.